Hi there, and welcome back to the Life License Qualification Program video series. Again, my name is Jason Watt, and what we're going to be talking about in this particular set of videos will be the funding options for group insurance. Now, you've looked at group insurance in a little bit of detail at this point. You've seen a broad overview, and you've seen how the pricing works in a very conceptual way. The next thing we're going to look at is the ways that we can actually choose to fund a group insurance plan. Now, I mentioned at the beginning when we were doing the introduction to group insurance that group insurance can be funded based on 100% employer contributions, or we can have group insurance where the employees contribute up to 50% of the costs of the plan. In other sorts of plans, in member and association plans, in union or association plans, or in creditor plans, then the members can actually end up paying as much as 100%. It's really for tax reasons that employers need to be paying at least 50% of the cost of the plan. When we set up a group insurance plan, a conventional group insurance plan structure is going to use what we could call the fully funded method of group insurance. In the fully funded method of group insurance, we have an employer, and this should look familiar to you. This is not a complicated idea. An employer who pays premiums to an insurer. The insurer takes claims from the employees, so we have the employees submitting claims, and then, as expected, and of course taking into account the coordination of benefits and the cost-sharing provisions that you saw back in Module 10, what's going to happen now is the insurer pays those claims as long as the claims meet what the promises that the insurer has made are. They're not obviously going to pay claims for things that they didn't intend to insure. But this is our conventional, fully funded group insurance plan, and this is probably how I think most people would think that group insurance would work. The truth is, at one time, this was how almost all group insurance worked. The employer paid the premiums to an insurance company. The insurance company, of course, charges a premium that's enough to cover the amount of claims that are going to be paid, plus a little bit of expenses. And then when the employees submit claims, the insurer pays those claims. Now, this is a pretty clean system, but look at this for a moment from the perspective of the employer. You're an employer. You're paying these premiums. The insurer takes your money and then only pays it back when your employees submit claims. Well, there's some things that could go wrong here in the sense that you as an employer might end up paying too much money. So your premiums are based on some of the factors we looked at in the last set of videos. Your premiums are based on what the experience of the group or of a similar group has been, or on what the insurance company would reasonably expect your group to submit for claims. It's not necessarily going to be the case, though, that your employees are going to submit those claims. In fact, it's very common in group insurance to have too much premium paid versus the amount of claims actually submitted. When that happens, it really means that you as the employer have paid too much. Now, that's one thing you might look at as an employer. You might say, well, that's not really fair. I'm paying more premium than what I necessarily need to be paying to make this thing work. Maybe that's not that exciting. Okay, what about this? Back in Module 6, you learned about the time value of money. And when you learned about the time value of money, you would have recognized that if an employer, and especially think about a large employer here paying millions of dollars in premiums. So the employer pays this large premium to this insurer. When are the employees submitting their claims? Well, it's not the day after premiums are paid. It's going to be months and months later. So you might have an employer who pays premiums on August 1st, and sometime in August the employee goes to the dentist, gets their teeth cleaning done, whatever you happen to have, and then sometime in September or October the employee gets around to submitting the claim. Well, you paid your premiums in August, and that claim's not going to end up being paid until maybe October or November. So the time value of money says, well, hang on a second, insurer, you're sitting on all my money for that period of time. It would have been better off in my hands. I could have been sitting on that money. So employers have looked at these situations and said, well, maybe that's not ideal. What if we put in place a plan where we're going to take on that risk? Well, it's possible. We can have what's called a self-insured plan. Now, in reality, almost nobody calls this a self-insured plan. These are almost always referred to, and this is what you'll most likely see on your provincial exam, for example. These are almost always referred to as administrative services only, or ASO plans. I'll show you why in a few minutes we use this terminology, but for the time being, think of self-insured or ASO really as being the same thing. So in a self-insured plan, the employer really cuts the insurer out of the loop. And what we're going to do now is the employer just budgets for the expected claims. And now, we're not paying a premium. Instead, we're going to have the employees submit claims, and then the employer pays those claims. Which solves the problems that we saw from the employer's perspective. The employer has this money now, so if there's less usage than expected, the employer can retain that surplus, and the employer has the money, so the employer takes advantage of the time value of money instead of passing that money on to the insurer and having the insurer pay out claims sometime later.